Hello investors, I'm Stuart Cruz and welcome to Cruz Asset Management's video chart of the day. And today we're going to be talking about your 401k. I know you have lots of options on how to invest. You have some mutual funds and a lot of you don't know what's a good way to manage them or even what any of these funds mean. Well, I have a kind of a quick and easy way that can lead you towards the right direction. So this is what we have here. We have a chart of the S&P 500 up here, and let me tell you about this chart. Each one of these, this is called a candlestick chart, and each one of these little candlesticks represents a month. And let's take a look at this chart. This red candlestick here basically means it was a down month. And this was the low point, and this is where it closed at. So the very low at the thin part of the candlestick is the low part of the month. This fat part of the candlestick is where it closed at. And if we look at the top, then that's where it opened at. So it just basically went lower for that entire month. So what you want to do is do a 10-year chart with monthly candlesticks. And you can do this candlestick chart, what's called a MACD, and then a stochastic. And these are available on just about any kind of charting software. You can use Y charts like I use or use something else. This particular chart is through TD Ameritrade. And here's the secret sauce. When you put in a 10-month moving average, so this is a simple 10-month moving average, this purple line, and when this candlestick is above the 10-month moving average, that's a buy signal, sorry. And then in your MACD, when you have a green line, the histogram is above the 0 point, that's a buy signal. And when you have this purple line is either an upward trend or above the 80% mark, that's a buy signal. So when you have 3 buys, you get in. 3 sells, you get out. Now, if you want to be more invested than not, then you could just wait for 1 buy signal to get back in. But if you want to be more conservative, you have to wait for all 3 buy signals to get back in. So let's look how this would play out in the S&P 500. Here, we would have above the 10-month moving average. This is a green line here, and this is still trending down a little bit, so we'd wait until about right here where we're kind of flat to moving back up. And so we would basically get in right here, and you would be in until you had all 3 sell signals. So as long as this is green, then that's 1 buy signal, so that's not all 3 sell signals. And if this purple line is above that 80% mark, whether it's going down or up, that's a buy signal, so go ahead and stay in. So you'd be in, all the way through here. Here you're still above the 10-month moving average, and so you wouldn't consider getting out till maybe here. You're peeking out here. This is red. This is possibly a sell signal. Oh, but we're still above the 80% move line. We don't get to that negative part with a downtrend till about right here. That's when we'd sell. So we would stay out, because that's red. This is below the 10-month moving average. And then about here, we'd get back in. So this round trip of selling and buying didn't really save you any money, but you got out and you missed some volatility, and you would get back in right about here for this long upward trend. Now remember, these are all months. So from here to here, I don't know, what's that, 18 months, 2 years? And then you see some choppiness. Now, what we just saw was during the coronavirus, and we actually saw this in 2018, we saw a quick sell-off, and then a buy, and then a quick reversal. So we wouldn't have gotten back in till about here, and you would have caught part of the sell-off and missed part of the run-up. So why would we do this? Well, it doesn't always work out that way. You don't always get this quick reversal like you had these last 2 times with the coronavirus, where you had a sell-off. We would have gotten out at a bottom part, and then we would have waited to get back in till about right here. And here's about when we get back in, which was last month. So we'd have missed a big run-up. So why use this? Well, it's not really for these V-shaped recoveries that we see. It's more along the lines for these longer term recoveries. So now here's a chart of the international stock market from our friends at Schwab. So as you can tell right now, like here we would get out, and you'd be out for all this volatility. You'd still be out. So you would sell, and you wouldn't get back in till about here, but you'd be able to ride this uptrend, ride up, and then here, you'd get out, and you would be out for this downtrend. And then you'd get back in about here, and you'd ride up, and you'd get out for this downtrend. And you'd still be out to about here. You'd get in. Now, it doesn't look like you're in for very long, but it's still 6 months. So think about that. That's 6 months of time in this short period of chart. You get back in, and you would have had some of the loss, but you'd get back out, and you still would be out till about here. But think about this. You would have ridden this part up, missed most of this down, ridden this part up, missed a lot of this down. You would have captured some of this down and missed part of this up. But the net result is you come out ahead. Let's look at another example. So we're going to look at this growth ETF from Schwab. And more particularly during the coronavirus. So here you're in, because that's all green. This is all above the 10-month moving average, above the 80% line. You're in, you get out through here. Doesn't really help you much, but you miss volatility. You're in all the way through here. You're out again in that 2018 section. But here's where it's pretty amazing. You would have captured some of this downside. You wouldn't have gotten out till about here in the coronavirus. So that's 1 month, and that's how long this downturn lasted. Then it rallied immediately. And then had you been following this pretty stringently, you would have gotten back in May. And most of the pundits out there would say, no way should you have gotten in May. Unemployment was still high, GDP was going to be low. But from that point on, you saw a humongous rally, and you would be in growth stocks. And we'll go with one more example of a way that you kind of avoided. Maybe we'll do two. Where you could have avoided some big downturns. Here is a ETF of junk bonds, and here you would miss on the way down. You would be participating on the way up. You would have missed some of this volatility, but here you would have gotten out because you're below the 10-month moving average. The MACD is red, and this is on a downward trend, and you would have missed. This is what, a year and a half of downward movement from the junk bonds. So you would have been out for that. And you would have gotten back in around here, participated, and then again, you would have missed all of this downward movement, gotten back in, nothing would have really happened. But here's where you missed this big downswing from about 123, and you get back in at around 104. So you save about 20% on the downside. But you don't participate in this whole big swing all the way down to 93, 95, right? So what this does is it protects your portfolio from losing a boatload of money. And if you do this with all the asset classes in there, then you have a system that you don't have to second guess. And if you're in, you're in. If you're out, you're out. So you protect your portfolio from big downturns when they come, and you can participate in the big swings. For example, everybody knew that interest rates were going up and that bonds were going down. And here we have the iShares Trust of the core US aggregate bond ETF. So right here, you would have gotten out. As everybody knew, you should be out of bonds. But here, this is 2 years ago, you would buy bonds, even though interest rates were still low, and they have rallied in your face for 2 straight years. So if you'd have been long bonds, which very few people said to be long bonds, you would have definitely made the right choices. So it doesn't always work, but it works more often than not. And that's all we're trying to do is slant the odds in your favor. So there you have it, a quick and easy way to manage your 401k. If you get 3 sell signals, you get out of that particular asset. 3 buy signals, you get back in. It's a systematic approach that has worked over time, and all we're trying to do is slant the odds in your favor so that you have a way to sidestep big downward trends, miss some volatility, and still participate in the upward market moves. Because remember, the trend is your friend. And don't forget to invest with the odds in your favor. This is Stuart Cruz from Cruz Asset Management signing off, and I'll see you in the next video.